Beijing is cracking down on private companies, sending shockwaves through stock markets. The blue-chip Chinese CSI 300 index plunged 3.5% today, while the Hang Seng Tech Index tumbled almost 8%, losing a whopping 17% in just 3 days. Now traders fear that the crackdown will spread to other sectors. NTD's Colin Frederickson asked an expert about what investors should do next.
Investors who hold Chinese stocks are facing growing risks while Beijing keeps cracking down on private businesses. Chinese tech companies just lost hundreds of billions of dollars in market value, and the sell-off hasn't ended. Joseph Trevisani, senior analyst at FX Street, says that the Chinese regime is concerned about losing control.
Tech companies control a lot of information access in China. And China is not a free or open information access society. And this is a direct threat.
And on top of that, he says the regime wants to avoid public unrest. Current inflation rates might generate objection among Chinese consumers.
So I think one of the things that they're trying to do with the crackdown is to frighten companies into not raising prices so that they don't have this flooding out into the consumer economy.
Oliver Jones, senior markets economist at Capital Economics, says these events show that the authorities are more willing to upset investors than before, and large investors have already started to unload their shares. Cathie Wood cut holdings to less than 0.5% this month. The sell-offs and drastic moves show the decline in investor confidence. After targeting tech companies, Chinese officials recently turned to the education sector. Fast-growing tutoring companies are now barred from turning a profit and from raising funding on stock markets. Tencent dropped 9% in Hong Kong and has hit its worst day in a decade. And now Chinese regulators issued new guidance for food delivery workers, shortly after shopping platform Meituan plunged. Tencent, Alibaba, and Meituan combined have lost almost $240 billion over the last 48 hours. But Trevisani says investors should not pull out of Chinese stocks just yet.
It's not something that is developing sort of organically in the economy. It's a top-down, ordered change in behavior and a warning that will eventually be withdrawn.
He says once that has happened, the Chinese stock market will likely revert to normal economic behavior. Colin Frederickson, NTD News.